Hello, you're watching The Annuity Show, and we are joined today by Elise Roberts, the president of Secure Today Financial. She's going to talk to us about two of the most popular annuity writers, ones that secure income and ones that protect your beneficiaries. So Elise, let me ask you this. We talked a little bit in our last episode about how income riders work, but I wanted to ask you, can income riders give you growth before the payouts begin?
Yes. And the best thing about that is some people don't need income right now. So they don't want to put money in that's not going to grow. They would wait. And that's not a good idea because the annuity could be there to protect the money so that when they do need it, let's say 3 years, 5 years down the road, then it's there in the annuity with the income rider ready to be paid out. But that payout could be more if they're waiting. So during those years that you're not taking the income, yes, absolutely, our goal is to grow that money. Grow that money so that check is bigger. And then also just if someone's doing income later, we have to know whether that income needs to increase. Because if someone's pretty young, they should never have an annuity that has an income that is not going to increase.
Right.
There's no protection for inflation or anything in that situation.
Right. Inflation is such a big concern, especially if they're younger. And I think that's so interesting for people to understand because, at least in my mind, when I think, oh, income, if I'm getting income, then in my mind that means the amount's going down. But you're saying it can be growing before the income is coming out.
Yes. And let's say someone starts the income in 5 years. We've grown the account. It went from $300,000 and now it's worth $500,000. And then we start the payout. The greatest part of that is here's what happens. When you're starting to take the payout, the money's going down.
Right.
But the checks are going up.
Right.
Because you're using your money, but the checks are never going to be less. Those are older annuities, different annuities, and I don't usually offer a check that was never going to either stay the same or be more. Because as you get older, you're not going to need less and less money. People say, oh, but I won't need as much. Inflation's still in there.
Yeah.
And all kinds of reasons why you might need more.
Right.
Healthcare, just different things as we age.
Travel, maybe you want to do fun things when you're retired. Yeah. I think a lot of times people don't take into consideration that they might actually need more money when they're retired because they want to enjoy their life.
Right.
So let me ask you this. I want to shift gears a little bit to the death benefit riders. Can you explain to us what is a death benefit rider? How is it different from life insurance?
That's a great question because the money that's coming out of an annuity for the death benefit, let's say you pass away, the money that's going to pass to the heirs, that money is dependent on the type of money you put in, whether it's tax-free. So life insurance is tax-free death benefit.
Right.
This is money you might have used your IRA. You have taxes due there because it's an IRA.
Right.
The only way to have tax-free death benefit outside of life insurance is an annuity using your Roth.
Oh.
So that's the only way to make sure you're not paying any tax. Because otherwise, if you put in $300,000, that money you put in, you're not going to really pay tax on that part.
Yeah.
You're going to pay tax on the part that grew because it's tax sheltered. This is going kind of off the subject of the death benefit rider, but the money is tax sheltered while it's in the annuity, but when it comes out as the death benefit, then it just depends on the type of money of how the taxes will work.
Right, right. Again, like I say, every time we talk about annuities, so complicated, so important to have someone who specializes and really understands all those little nuances and all the differences that a person needs to take into consideration when they're trying to decide what's right for them. Really important. So speaking of when a person's trying to decide what's right for them, can you think of any examples of cases with clients that you've had where a death benefit rider has really been the best fit for them and why?
I have actually a case that's recent. The gentleman came in and he's putting the money into the account for his grandkids. He's not going to need the money, but he's not well. And he knows that's going to happen. Now, if he was trying to get life insurance, he would be denied.
Oh, right.
So he knows, and these death benefit riders, some of them will add 30, 40, 50% to the money if you just know that's only going to pay out if you die.
Oh, wow.
So the insurance company isn't asking medical questions.
Right.
This is part of it. This is an annuity. It's not life insurance. So there's no medical questions asked. And he was able to put in the money and get a 40, I believe it was 40% at the time, 40% more money that his kids, grandkids will get, period. That's the least amount of growth. If he lives another year or two, I hope he lives a lot longer,
Yes.
but he's very ill. And if he lives another year or two, we're growing that money on top of the 40% that is passing to his grandkids.
Wow.
So there's a great way to use a death benefit rider. This one happens to be at no cost. It's just one of those plans. There is no cost in it. And it's really a great, perfect fit for him being ill, or knowing that his life is shorter. And he knows that.
Yeah.
And he came with me to get the help because, there's so many out there. Of course, the money that you put in an annuity today, if you pass away, all that money is going to pass. But that's just the money you put in. So we have to make sure we grow the money, and maybe we have a bonus to make sure that we're really enhancing it for the purpose that that client needed,
Yes.
which was the death benefit.
Yes.
That was his focus. And he came in with, here's what I want, here's what I need, and here's who I want to help. And these were his grandkids.
Yeah, he wanted to take care of his
Yeah.
grandkids. I mean, that is such a powerful story because I think that in itself is a huge differentiation between life insurance and having a great death benefit rider on an annuity because, like you said, he probably wouldn't have qualified for life insurance or almost certainly wouldn't have. So that's an amazing alternative for someone who knows that they're not in the best of health, knows that they're not going to pass those medical questions on a life insurance application. So they're able to have this alternative option that really takes care of what they need without having to pass any kind of physical examination that they won't
And
be
that
able to.
particular rider, zero cost.
Wow.
Unbelievable. It was such a great fit for him.
Oh, that's perfect. Well, let me ask you this. Speaking of, you said that one is zero cost. Are they all zero cost? What are the costs associated with these riders?
So it just depends on the company. But the average fee or cost in an annuity that has a rider, and that would be around probably 0.95 to 1.5. Just depends.
Okay.
They're usually not much more than that. It's probably what you would pay to have your money at risk with a brokerage account, that kind of fee. But they don't all have a cost. And the death benefit pays out. It's
Yeah.
immediate. Now, in this case, because they gave him 40%, his heirs will get 5 checks, which is beautiful because he loved that.
Yeah.
Because he knows these kids are younger. They're not
Yeah.
babies, but they're young, teenage, 20-year-olds. And he wants them to have the money come in
Staggered.
over a short period of time where he's not giving them a lump sum.
Sure.
And so it's a perfect fit. And the company, the reason they do that is, they're giving him 40%. So having that 5-year buffer is a benefit for the company, but it's a benefit for him because, depending on the type of money someone else would put in, let's say it's an IRA, his was not, but let's say it was an IRA, all that money is passing taxable to the heir or heirs. And so therefore that 5-year really helps cushion the taxes.
Sure.
And keeps them from going in another bracket.
Oh,
so
yeah.
the 5-year payout is really a positive, and if it's not a good fit, then we switch gears and find something else.
Yeah. Oh, wow. Well, as always, I have learned so much just talking with you for a few minutes. We have run out of time for this day. But before we go, I want to encourage you to reach out to Elise and her team. If you heard something today about a death benefit rider that sounds like it might be a good fit for you, give her a call at 888-526-4184, or you can go to theannuityshow.com or just click that QR code you see on your screen. Thanks so much for joining us today. I look forward to seeing you next time on The Annuity Show.